Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin.
Good morning, everyone. Sorry.
Good morning, and thank you for joining us for today's Voice of Experience webcast. We have two great speakers from the Moss Adams Healthcare Practice speaking on our topic today. Bob Ahern is the partner in charge of the Healthcare Services Group in our California Valley office, and Rob Granum is the Washington practice leader for the firm's healthcare group and serves as a member of the firm's healthcare reform. And now I'm going to turn it over to Rob to begin today's presentation.
Thank you, Brooke. Jumped in a little too early. Welcome, everyone, and thank you for attending our annual tax update for the healthcare industry. We've got, I'm going to forward it to our agenda. We've got a lot of content this morning on a wide variety of topics impacting individuals, families, businesses, both for-profit and exempt. And so some of the content we may go over quicker than we'd like to, but we've got a lot of content and everyone will have access to the slides after the presentation. I might also suggest pointing you to our website where we've got our annual tax planning guide for individuals and businesses that was distributed a number of weeks ago, but it is on the front page of our website. You'll see it if you scan through kind of the top 4 items. I think it's right there in front. So that's our plan. We'll run through a couple high-level items that are going on from a tax standpoint, and then spend quite a bit of time on individual impacts, and then finish up with second half will be on business impacts. And feel free to submit any questions that you might have. So there hasn't been a whole lot that has necessarily changed from a tax standpoint in 2014. There hasn't been really any legislative changes, although a number of things have expired in 2013. You might be familiar with the tax extenders, which has Congress gotten into the habit over the last half a dozen years or so of continually extending a number of provisions for just a 1 or 2 year period. That did not happen in 2014, so a lot of provisions, and we'll touch on these in a couple slides, have not been extended. They expired at 12/31/13, so we have some uncertainty with regards to the extenders package that's going to be in play for 2014, if any. The House did pass an extenders package on December 3rd, a 1-year extenders package that would be retroactive to January 1st of 14. The Senate has yet to pass it, although they have made all indications that they will. However, today, I believe today is their last day before they go into recess, and they've got other issues that they're dealing with this week with regards to funding the federal government. So it just has not risen on the priority list necessarily, but hopefully maybe today they can get that done and retroactive a bunch of tax extenders to January 1st. And a lot of this should have been done last spring, but the political stalemates got in the way. So I think the important thing is there are a lot of uncertainties with regards to the extenders, largely with if you're a for-profit, from a business standpoint, the depreciation impacts are probably some of the largest, and as well as R&D impacts. So it's a matter of making sure that you balance that with your year-end planning. A few other considerations from a high-level tax standpoint that's going on in the landscape is obviously with the midterm elections, Republicans obviously control both chambers of the House and the Senate. So it's a matter of, well, how will that impact tax legislation going forward? I don't think it has a whole lot of impact with regards to an extenders package because that's hopefully going to be done by today. But to the extent that it doesn't get done by this year, I would presume that the new Congress, come the first of the year, would pass an extenders package that would be retroactive. What's unfortunate about the extenders package at this point is we're just talking about a 1-year extension, retroactive, and it bears zero incentives, if you will, for taxpayers to plan or be incentivized to do anything. Tax reform continues to be a discussion point in Congress on the national level. Some of the drivers for overall tax reform or tax overhaul of the code, some of the drivers are the simplification from a compliance standpoint, simplification of the code. That's a big driver. Another big driver is deficit reduction. Another driver is kind of the international aspects of how competitive our corporations are, so corporate tax rates. The U.S. is one of the most highly taxed from a corporate standpoint, so there's a lot of there's a big appetite on both sides of the aisle and with the White House to drive corporate rates down from a high of 35% down to 28, 25%. Now, everyone also is in agreement that whatever kind of package we put together needs to be revenue neutral. So with that, there's going to be, there's always winners and losers, and so there's going to be some revenue raising provisions in an overall tax reform, likely on the individual side, not on the corporate tax rate side. On the individual side, I could see rates kind of inching up a bit. The other is from a healthcare perspective that could impact a number of physician groups would be the cash method of accounting for tax purposes is definitely on the discussion table as far as doing away with that. That would be a one-time significant revenue-raising event for the federal government. But there's a lot of, this would be for all professional service providers, which healthcare falls into, so there's a lot of lobbying against that, but that's definitely on the table. Paul Ryan is the new chairman of the Ways and Means Committee. he definitely believes tax reform should come forward. So there could be, we've obviously got 2 more years with the current administration, so it may be tough to get tax reform done. However, the federal government is coming up to a debt limit increase discussion in early 15. Seems like we just had this with the sequestration and fiscal cliff discussions a couple of years ago, but we're going to be approaching that again. And there are talks that there could be a grand bargain early in 15, which would include some tax reform. So we'll see. Obviously, the reason why tax reform and the extenders and so forth have not gotten a lot of attention is because there's obviously been a ton of other priorities and distractions, as you can see on the screen, with the various items at a federal level that have kind of taken the front stage. But we shall see. This slide, it might be a little tough to see. These are the tax, essentially the tax extenders. Not all of them, but these are some of the more prominent ones. There's, I think there's around 55 provisions that are kind of on the docket to be extended, that continue to be extended. Kind of the more prominent ones that I'll point out, on the individual side, it would be for those of you that live in a state with sales tax, it would be the deduction for state and local taxes. For those of you that reside in Washington, for instance, that's been a big tax break for individuals, is the deduction of sales tax. That's one. So these are currently not in play for 2014. The tax-free from a charitable standpoint, the tax-free distributions from an IRA to a charitable organization, that's a big benefit. For businesses, the biggest ones would be the R&D tax credit. That continues to be extended. It has for the past well over 10 years. A couple of the big ones is the Section 179 expensing, and the increased limit in 2013 was $500,000, being able to expense up to $500,000 for qualifying property with a $2 million phase-out threshold of purchases. That has been dropped to $25,000, so it's a significant difference. So the extender package would bring that back up to $500,000. The other prominent one is bonus depreciation. That's 50% bonus depreciation on the acquisition of a qualifying property, which is largely property with a life of 15 years or less. That is another item that Congress is looking at extending for 14 retroactively. And then finally, for businesses, the other prominent is the 15-year straight line recovery period for largely for qualified leasehold improvements. And that's significant. The timing difference there is either going from 39 years to 15 years and also triggering bonus depreciation. So the recovery of your investments in real estate and property, plant, and equipment is significant if these extenders bills pass. But again, it's a retroactive measure, so it doesn't necessarily provide us any incentives to go invest in these things next year without the certainty that the law is going to be there. So those are kind of the big ones. There's a lot of discussion about making a couple of them permanent, and that's been kind of a sticking point with the House and the Obama administration. And the permanent ones would be the R&D tax credit and the Section 179 expensing limits. There's a lot of folks that want to make that permanent, but that's been a sticking point. Okay, we're going to come to our first polling question, which is, what type of organization do you work with? A physician group, a hospital, med device company, long-term care, a health plan, or any other type of service provider. So we'll give it a few minutes and we'll see the results. Okay, let's see the results. And Brooke, do I just advance the slide or hit submit? There's the results. So it looks like a mix between physician groups, hospitals, and other providers. Okay, now I'm going to turn it over to Bob, who will spend some time jumping into individual income tax planning strategies. So go for it, Bob.
All right, Rich. Rob, thanks, and good morning, everybody. Regardless of what organization you belong to, everybody will have the individual tax law will have effect on everybody as long as you're filing a return. So I'm going to spend the next, 20, 25 minutes or so going through some of the individual sections. There's 35 slides or 36 slides or so that I'm going to fly through. So hopefully I'll give it enough time. But as I keep calling you Rich, as Rob mentioned, we do have our year-end tax guide on our website at www.mossadams.com, and that will have more detail on this. In fact, this presentation is kind of was made in conjunction with that. So what we're going to talk about this morning are these 7 items. I'm going to spend most of my time on the first one, on the personal income tax section, and then we'll touch on the estate planning, some charitable giving, a little bit retirement planning, wealth management, international considerations, and healthcare reform. First thing on the personal income tax, the tax brackets are the same as last year. The top bracket of 39.6% is still the same as what it was in 2013. The amounts have been increased a little bit. The top rate to hit that top rate, if you're single, it's at the $406,750, which is up a little bit. All these numbers are up due to inflation. Married filing joint, if you're at $457,600, you'll be at the top bracket. The other types of tax, ordinary income, I just mentioned, the 39.6 is the top federal bracket for 2014. Net investment income and passive income, and we'll be talking a little bit more about that in a second, but that top rate is 43.4, which is at 39.6, plus there's a 3.8% net investment income tax at certain income levels, and again, we'll be talking a little bit about that in a few minutes. The long-term gains and qualified dividends, those are 23.8. That's the top bracket. Again, those are 20% plus that 3.8% net investment income tax. All those first 4 items there, you hit those top rates at that either the $406,750 for single or $457,600 for married filing joint. And then the estate and gift tax top rate is 40%. This chart shows the break points and the different tax rates of different types of income. So you see the first column is for the single folks, then the married folks in the second column, and then the types of income. We got ordinary income, which is a regular tax, and there's 7 brackets there. Then there's the capital gain and qualified dividend rates, and there's 3 brackets, counting the 0 bracket. And then there's this Medicare surtax and the net investment income tax. And these last 2 columns are in addition to the ordinary income and the capital gain rates. So again, at certain income levels, you can see at the top bracket, you could be 39.6 ordinary income plus another 3.8 on your net investment income tax. The point of this is that really it's not about just reducing your income to be most effective on your tax planning. It's what type of income, because certain types of income are taxed at different rates. These are the different types of considerations that you need to take a look at when you're looking at your personal income taxes. And in addition, if you're a business owner, the tax consequences of your business do have an effect on your personal tax planning strategy too, especially if you have a flow-through business like a S corporation or a partnership or an LLC. So we're going to talk now about this net investment income tax and also the Medicare additional Medicare tax or Medicare surtax. These were introduced first in 2013. We've got a little bit better handle on how this works, but this slide shows that if you're single, there's a threshold on your modified adjusted gross income. So if your modified adjusted gross income is over $200,000, you could be subject to both of these taxes. Married filing joint is $250, and then married separately at $125, and so on. You can see on the schedule there. The net investment income tax is at 3.8. I'll call it the 3.8 tax, and then the 0.9% tax is the Medicare tax, and we'll talk about both of those here right now. So the point here is that the 3.8% and the 0.9% tax, you could be taxed on both of these, but it's not the same type of income. So you want to make sure that you're taking these additional taxes into consideration and making sure that your withholding and or estimate payments are sufficient to cover these taxes, because otherwise you could be subject to some underpayment taxes. So the type of income and the net investment income tax. Now this is for the 3.8% tax. So that would include interest, dividends, capital gains, net rental income, royalty, non-trader business income, and then other passive income like limited partnerships and things like that. Things that are not included in that would be your wages, your self-employment, your active trader business income, retirement plan distributions, alimony, Social Security, interest on tax-free bonds. I guess there was somebody from Alaska on the committee when they wrote this bill, so there's an exclusion for the Alaska Permanent Fund Dividend, and then some unemployment compensation and gains that are excluded from gross income, so non-taxable type items. Those first two items, the wages and the self-employment income, they are excluded from this 3.8% tax, but as we'll see, those are the two that are included in the 0.9% tax. So let's take a look at a couple of examples here. I got three examples that I'll fly through here. But you've got this first one here, you've got a single taxpayer who has $300,000 in wages and $100,000 in net investment income. Again, that might be interest, dividends, or capital gains or something like that. So the total of their modified adjusted gross income is $400,000. The first thing you do is you look at how that compares to the threshold. This is a single filer, so the threshold was $200. If this was a married couple, it would be $250. But in this example, it's single, so the threshold is $200. So the excess is of the adjusted gross income is $200,000. So then you compare that number to the net investment income of $100,000, and you take the lesser. So the lesser of those two items is 100 times 3.8%, so you pay an extra $3,800 of tax. Then you look at the 0.9% tax, and that's just on wages or self-employment income. So you take the $300,000 wages, again, less the threshold, the $200,000. The excess is 100,000 times 0.09 or 0.9%, and that's $900. So the total of the total additional tax is $4,700. All right, example B is the same single filer, but instead of $300,000, now they have $150,000 in wages, and that same $100,000 in the net investment income. So their modified adjusted gross income is $250,000. So you're looking at the excess over the threshold. The $250,000 minus $200,000 is $50,000. The lesser of the $50,000 or the $100,000 net income is the one that is subject to the 3.8, and that's $50,000. So that times 3.8 is $1,900. The wages are less than the threshold, so there's no additional Medicare tax. So their total additional tax in this situation would be $1,900. And then the last example is, again, the same facts as the prior case, 150 in wages, 100,000 in investment income, plus we're going to throw in a $50,000 loss from a business. So now their modified adjusted gross income is now 200, because you got the 150 plus 100 minus the 50. So now they're not over the $200,000 limit for either the 3.8% tax or the wage, the 0.9% tax. So there is no additional tax in this situation. So that's how this thing works. And so as we go forward, we can look at some planning opportunities here. And so some of the planning opportunities would be to look at your income as we get towards the end of this year and check to see where you are with respect to those thresholds. And if you do have significant net investment income, or if you're, if you do, then take a look at whether to defer some income, or maybe if you're not up to that limit this year, but you may be next year, you might want to look at accelerating some income into this year if possible. So what you want to do is look at the multiple years and see how the income's going to play out if you can, and try to maximize your benefits here. There's also possibly prepaying some state income taxes, because some of those actually become a deduction for your net investment income. You want to look at, if you're in alternative minimum tax, and we'll talk about this a little bit, you're not going to want to do too much with that. And then deductions from qualified retirement plans, if you maximize those, you can reduce your adjusted gross income. You also want to look at your investments, rebalancing your accounts to get more, maybe some tax-free income or tax-deferred income, maybe some other types of income that can be sheltered by depreciation and so forth, and doing 1031 exchanges to defer the income. Those reduce your net investment income for this purpose. Other ideas are looking at looking at the installment method to spread out the gains, or looking at how if you own real estate that you're renting to a business that you own, you might be able to group things and get it out of the investment income. So there's there's a lot of different planning opportunities here if you are in the subject to the 3.8% tax. If you've got a trust, the limits are different. The 200 or the 250 thresholds that we have for single or married filing joint, for a trust it's only $12,150. So if you've got net investment income in a trust, you might look at ways to distribute that out to beneficiaries who might be below those 200 or 250 thresholds and avoid the net investment income tax that would be subject in the trust. If you're a business owner, self-employment income for sole proprietors or for partners in partnerships or members of LLCs, the self-employment income is part of that 0.9% calculation. If you convert to an S corp, for example, and any distributions from S corps are not subject to it. So there's a possible planning opportunity too, if it makes sense. So it would behoove you to kind of take a look at that and see how your situation is affected by these two taxes. Now we're going to move on to capital gains. As I mentioned before, the capital gain rates are 20% if your taxable income exceeds those dollar amounts that are on the screen. If you're exceeding those limits, you're probably in the 3.8, subject to 3.8% as well. So it's 23.8. If you're less than these, you're at the rate is 15%. And actually, if you're below 70, I think married 73.8, it's 0%, and for single it's 36,900. If you're below that taxable income, there is no capital gain. So So you want to look at your capital gain situation and maybe look at harvesting some losses before the end of the year if you have significant capital gains. Also, if you plan on making some charitable contributions, if you donate appreciated stock, for example, or you can get a deduction for the fair market value, and you won't have to pick up the tax on the gain, either for capital gain tax or the net investment income tax. So that's another planning opportunity. Now, as far as deductions go, again, you want to look at your situation and look at whether you want to accelerate certain deductions or defer them, depending on what your situation would be like next year. There's certain expenses like medical expenses on your itemized deductions, which are limited by your adjusted gross income. So if you don't hit those limits, you might consider, if possible, bunching them. So you take 2 years of expenses and put it into one, see if you might be able to exceed those limits. Miscellaneous itemized deductions is another one where you might want to look at bunching because there's a 2% of AGI limitation. And also, you want to look at, do you want to pay your fourth quarter estimate state tax, which might be due in January, or your property tax, which might be due in the first quarter or so of the following year. If you want to prepay that, but you want to be careful because if you're in alternative minimum tax, that state tax won't work. And speaking of alternative minimum tax, you want to look at what triggers it. There's a lot of people that are in that I work with, a lot of physicians and so forth that are in AMT. So it kind of changes your thinking on tax planning, because if you're in AMT, say for example you're going to be in AMT in 2014 and maybe not in 2015 for whatever reason. Alternative minimum tax, you're taxed at either 26 or 28%, and you might want to, if that's the case, you might want to accelerate income into this year and pay the 26 or 28% tax in order to possibly avoid tax that might be at 33, 35, or 39.6% in a future year. So you want to really consider whether you're going to be an alt-min or not, and take that into consideration when you're doing your planning. I mentioned the state taxes. State taxes are not deductible if you're in alt-min, so it doesn't make sense to prepay those state taxes or property taxes, or it's not just state, it's taxes are not deductible. So, and also equity mortgage interest is not deductible. So that last bullet point, it says if you're planning on buying a house, consider maximizing the mortgage. I hadn't thought of that till I saw this slide, but if you're gonna end up buying a house and then subsequently getting an equity loan, it would be better to get the loan up front, so it'd be considered acquisition debt. A little bit about college education planning. The American Opportunity Tax Credit is a credit it's a credit of up to $2,500 of certain college expenses. It's available. The college expenses are for the first 4 years of college. If you're not eligible for that, there's a lifetime learning credit, which is a $2,000 credit, up to a $2,000 credit, or the tuition and fees deduction, which is up to a $4,000 deduction. There's, on all of these credits and the deduction, there's a phase out at a certain income level. So high income taxpayers unfortunately can't take full advantage or any advantage of these, but you want to look and see if that's available. On the 529 account, those are still available. You can accumulate funds in there for college expenses for children or grandchildren, and the earnings in there are not taxable either for regular tax or for the net investment income tax. Estate and gift, the estate exemption this year is $5.34 million per spouse. That's up a little bit for inflation. The top tax rate, as mentioned before, is 40%. Portability is available, and portability is the availability to use your spouse's. If your spouse passes away and has some unused tax exemption, you can add that to yours as long as you file a return. And then there's also some state inheritance tax issues. I'm in California, so we don't have that here, but I know other states do have a state inheritance tax, so it's important to consider that. Also, for gifting, the annual exclusion is $14,000 per person. If you have large gifts, you can actually exclude up to the estate exemption, which is $5,340,000 without paying any tax. You will have to file a gift tax return, but you don't have to pay any gift tax until you exceed that lifetime amount. The $14,000 you can do each year. A husband can do it, spouse can do it, so you can give actually $28,000 per couple to a child. And if the child's married, you can give 28 to the husband, 28 to the wife. So there's some planning opportunities available there. There's also some very low, the applicable federal rates, the AFRs, are very, very low right now. I think for long term, they're somewhere in the below 3%. So there's some opportunities there that you can do some estate and gifting, some planning there. Let's see if I had anything else on that one. Nope. The key thing on the estate planning is to look at your estate plan, make sure it's up to date, make sure it's meeting your needs, because laws change, life circumstances change. Make sure your assets are properly titled, the beneficiaries are correct, and particularly you want to make sure that the estate plan is in alignment with your business and personal financial goals, especially if you're looking at potentially having a transaction here in the next several years, like many, many people are, as I understand. As far as charitable giving, if you have gain property, you want to donate to a charity. If you donate the asset, you can get if you have say a $10,000 stock that you bought for $1,000 and you donate the stock to the charity, you can get a $10,000 deduction. You don't have to pay tax on that $9,000 gain, so you avoid the capital gain and the net investment income tax gain. So that's a nice deal. If you have lost property, you probably want to sell it first so you can recognize the loss and then donate the cash. And then you want to look at multiple years to make sure you're getting the best bang for the buck. And the charitable giving can also be looked at in terms of your estate plan, because there's some nice tax and cash flow efficient ways to structure gifts to get some benefit of those now rather than after you're gone. I get this quite a bit for deductions for donations. If you have a check, it's got to be postmarked by the end of the year. If you use a credit card, it just has to be processed and charged on your credit card statement. So it says December 31st on the statement, even though the credit card might not be paid till January or later. Documentation, if a donation is $249 or less, just a cancel check or receipt. $250 to $500, you need a letter from the charity. If it's from $501 to $5,000, you need a written acknowledgement. Plus, we'll need another form on the tax return, so you need to know when you bought it, what the date you bought it, what the description of it was, what the basis of it was, and so forth. If it's more than $5,000, you have to have an appraisal. So if you're going to donate property that's more than $5,000, you might want to talk to your tax advisor prior to doing that, because if you donated it during the year and then sit down in March to get your tax return done and don't have that appraisal, there could be some problems. So on retirement planning, you have there's certain types of plans. If you have a 401k or a Keogh plan, you got to get those set up before the end of the year. Even if you make the contributions later, set them up with $100 or so. If you have an IRA that you want to maybe convert to a Roth IRA, you can look at doing that. There's no income limits on that, and that's kind of a thing that some people have been doing is converting traditional IRAs to Roth IRAs in different type of class buckets of stocks or of investments, and then you can look at it next year and see how those investments are doing and possibly recharacterize it back to a traditional IRA. If you do a Roth conversion, there are some tax ramifications, so you want to get proper planning on that before you just go ahead and do that, obviously. And I'm racing through these because of the time limit. I apologize for that. There is a new rule starting in 2015 that you can do IRA rollovers only once a year unless it's a direct custodian to custodian. So some people have taken advantage. If you take money out of an IRA and then roll it back into that IRA within 60 days, you don't have to pay taxes on it. Some people have done that, multiple times if they have multiple IRAs, and use it as kind of a short-term loan. And starting next year, you can only do that once, regardless of how many IRAs you have. And also, if you have children that have earned income, you might want to get them started on a savings plan, or if they can legitimately work in your business, maybe pay them a salary and then get them to either contribute, or you can gift them some money to put into their Roth plan. Wealth management, tax planning is important, but you want to look at how it all fits in with your overall investment plan and your retirement goals. So you can work with your investment manager to talk about maybe harvesting those tax losses or converting into non-taxable income to avoid the net investment income tax and so forth. From a personal financial planning goal, you want to make sure you have a clear a plan and monitor it. You want to update it regularly. We can help with that. There's different types of things that might work better depending on your situation. So, make sure that you look at that. Make sure you look at your your insurance, life insurance, disability insurance. Make sure that the amounts meet your needs. Make sure your policies are right. Moss Adams Wealth Advisors are happy to look at your insurance policies to make sure they're meeting your needs, and they actually do that at no charge. Real briefly on some international tax consideration, if you have taxpayers living outside the United States or have non-citizen spouses, there's some significant things that you need to be aware of. If you're a U.S. citizen and you're working abroad, there's some foreign tax exclusions, and if you're a U.S. citizen that has assets, whether they're securities, bank accounts, real estate, things overseas in foreign countries, there's some complex reporting requirements that have been around for a while, and there's some significant penalties for noncompliance. So if you have some of that, talk to your tax advisor and find out what you need to do, because those are very important. And some of those filing requirements are due prior to when your tax return might be due. There's some June 30th deadlines and so forth. So you can't wait till October 15th to file your tax return and get that part taken care of. Health reform. The employer mandate has been delayed another year, but if you are an employer, and I think Rob might touch on this a little bit, you need to start gathering that information, even though you might not have to include it this year. If you're going to get health insurance through one of the exchanges, one of the state exchanges, that's got to be done pretty quick if you want to start that January 1st. If you you do have to have, the individual mandate is in effect. You do have to have health insurance in 2014, or you have to have an exemption. If you don't, there's some penalties. The penalties, don't seem like they're all that significant. It's $95 or 1% of household income. Household income includes dependents and so forth. But that penalty is going to increase over the next year and two. So it is required to have health insurance. So with that, I think I'm a little bit over time, but we're going to do our second polling question. So what areas are you most concerned with? Ordinary income tax, capital gains tax, self-employment tax, net investment income tax, or that individual shared responsibility payment, which was the health reform, the penalty. So we'll give that a few more seconds. Let's see here. We'll see what the results. Okay, everybody, and that makes the most sense because that's the highest tax bracket. That's the 39.6. So, all right, I'm going to pass this back to Rob and let him fly through the business section. So,
Great,
Rob,
thanks,
if you want
Bob.
to take it off mute.
Yep. Okay, so now we're going to touch on planning opportunities for businesses, both for-profit and exempt organizations. So we'll start with the health reform implications for employers. I think everyone's probably well aware of the employer mandate as part of the Affordable Care Act passed almost 5 years ago now, and it's been extended a couple times, and so now I think we're finally getting to a point where it's going to actually happen, the reporting of such and the penalties, and I don't see that being extended again, but who knows. So as of right now, employers will be required to report health benefits information for the 2015 year. It's optional for 14. And so there you be required to file an annual return going forward. Even if you're self-insured, you'll be required to comply with that. So the employer shared responsibility payment, or the mandate, applies to, in the reporting, applies to employers that employ 50 or more full-time equivalents or full-time employees, which is defined as those working 30 hours a week or more, or 130 hours a month. That is one item that might change, that hour threshold. There's been a lot of talk about lifting that up to 40 hours as defining an FTE. Like I mentioned, that the implementation has been delayed until 2015 for employers with 100 or more FTEs, and 2016 for employers in the 50 to 99 range. So starting in 16, basically everyone with 50 or more full-time employees will be subject to the reporting and penalty thresholds. And the coverage includes dependent coverage, and the penalties kick in. I don't necessarily have it on the slide here, but the penalties do kick in if your plan isn't rich enough or it's not affordable enough for the employee. It needs to meet a 60% actuarial value, that the employer is providing at least 60% of the value, and it needs to be affordable, which is defined as the amount paid by the employee can't exceed 9.5% of their household income. So it's got to meet certain thresholds. To the extent that you fall outside of that, you're not providing insurance to at least 95% or 70% in 2015, moving to 95%. If you're not providing insurance to at least 95% of your employees and it doesn't meet the minimum value standards and it's unaffordable, you will be subject to penalties, and there's two different types of penalties, the $2,000 penalty and the $3,000 penalty. And to get into the details of this, we would need a whole another hour, so I'll leave it at that. But I will say that starting in 2015, that measurement as far as your FTEs is going to be based on 2014, a 6-month consecutive window in 2014. So there's a lot of planning opportunities that do exist in this, so I would really encourage folks to make sure they're talking to their tax advisor and their health benefits advisors. The other big change that came into play in 2014 is the tangible property regulations. This is a big deal. It's got a broad impact for all taxpayers. It's effective January 1 of 2014, and it basically has to do with the acquisition or the production or the improvement of tangible property, both equipment or real property, a building and so forth. So this impacts all organizations, even tax-exempt organizations. And it's something the IRS has been kind of messing around with for the last 10 years, trying to address some rules. And the final regulations and everything finally became effective for January 1 of 14. So we're encouraging clients to make sure they understand these regulations, that they're determining an implementation plan to get this taken care of. There's a lot of elections and change in accounting methods that need to be considered and implemented for the 2014 tax filing season. So these elections and methods need to be done by the extended due date. For businesses, it's 9/15, and for individuals, 10/15. This is largely a compliance deal that the IRS is putting in place, but there are some significant and very favorable planning opportunities. A couple of the more kind of salient points is basically this just provided more clarity on whether you capitalize or expense improvements. And so there's some new terms here. I won't get into too much detail, but there's some terms as far as betterment, restoration, adaption, and then there's kind of some new terms or lines in the sand that have been drawn with regards to defining a unit of property for a building. We spend money on a new roof. Is that capitalized or is it expensed? In the past, we had to look to the case law to draw some lines on that. Now the IRS has provided just some more bright line tests for how you make that determination, and it's done through this unit of property concept in the betterment, restoration, and adaptation. There are some safe harbors available, largely for routine maintenance, deduction for minor building repairs. In the IRS, I would say that the IRS is expecting some method changes being filed for nearly all taxpayers. So this is just something that you definitely need to bring up with your tax advisor. Some of the key provisions, and this is this first bullet point, you can elect to recognize a loss on a partial disposition of an asset. This is a big deal, and so basically what this means is that we do a remodel let's say we do a remodel in a clinic, and we can essentially write off the remaining net basis of the improvement that we're basically replacing. In the past, the way it worked was I have a building and I put a new roof on. I've capitalized this new roof at 39 years, but I've also got the basis buried in a building number on my books for the original roof. Well, what the law now allows you to do is to basically dispose of that net remaining tax basis of that old roof. And so, and the big deal here is you can do that going forward, but in 2014, in the 2014 tax year, is the only year where you can actually go back in time. There's no limit. We can go beyond the statute of limitations for open tax periods, and we can basically write off improvements that are no longer there. And so it's called a partial disposition study. And I would highly encourage you to make sure you're addressing that to the extent that you've got a lot of remodels and building improvements and so forth. The other item that could be favorable to the extent that you've got audited financial statements is you can marry up your capitalization policy threshold upwards. The max is $5,000, so you can raise your capitalization threshold to $5,000 if you have audited financial statements. To the extent that you don't have audited financial statements, you can make an election, safe harbor election for $500 limit. You can still go over that limit, but you'll be safe at $500. So that's another election that I would likely expect many taxpayers to make on their current year return. Just a couple other planning ideas, and we've talked on some of these, but to the extent you've got depreciable tangible assets, from a planning standpoint, always consider cost segregation if you did a major remodel or acquired a building or built a building. These can be, cost segregation studies can be conducted at any time, even if you bought a building 10 years ago and you never carved up the components of the building for accelerating depreciation and accelerating into shorter lives. That can be done at any time, so it's a great planning tool. The other is Section 179. We talked about the thresholds there. We're hoping those get put into the extenders package and bring that back up to $500,000. The same with the bonus depreciation. That's 50% bonus. Hopefully that will be in this extenders package, as well as the qualified leasehold improvements, which is in the extenders package would be 15 years as opposed to 39, and it would fall into the bonus depreciation category. And also just be aware of state conformity issues with these depreciation rules. The states are kind of all over the board on these. Just quickly, business credits, pretty limited in the healthcare space, but there may be some opportunities. Credit for small employer health insurance, this is pretty nominal, but to the extent that you're under 25 employees, there may be some opportunity there. Employee benefits, just a couple points here on Roth 401k conversion, something to look at. The other is just be aware of, now that there's federal recognition for same-sex couples, that there's some benefits there that employers need to make sure that they're complying with. I'll kind of move through these quickly. This is more just a routine planning for flow-through entities, looking at entity basis, making sure that's all tied in. Buy-sell agreements are in place. To the extent that you're considering ownership transition, just making sure that that you've got plans in place and you're structured appropriately for that. An entity structure and Nexus Strategy aren't necessarily always aligned, but they should be. C to S Corp elections, still very, very common in this space, although with the reduction in likely corporate tax rates, that might slow a bit. But this is something, to the extent that you are a C, you should consider an S Corp election. Dividends always need to come into play with regard when you're planning for taxes, especially with this new net investment income tax. C Corps, the second bullet there, always a big item for professional service corps in the physician space as far as planning year-end taxable income. Okay, polling question. What provisions do you think provide some of the most, some tax opportunity for you? Tangible property regulations, property and equipment acquisitions, tax credits, or entity changes or entity planning? Okay, we'll close it out. Kind of all over the board. That's good to see, actually. Looks like there's a lot of planning opportunities for everyone, so that's great. Just a couple high-level thoughts on some kind of trends and observations that are out there with regards to tax-exempt organizations. A couple big IRS focus areas that we've seen just through exam activity and in discussions with the IRS. And it's nothing earth-shatteringly new, but unrelated business income, that's always something that's looked at from a standpoint for exempt purpose activities, and just an area the IRS is always looking at to assess tax. Compensation, employment tax, and worker classification, those are always continue to be issues, whether it's excessive comp for key personnel, or it's the employee versus independent contractor status. The other is tax-exempt bond compliance, and then transactions with key interested parties within an exempt organization's related parties. That's always an item that's looked at. Emerging structures and alignments, you know, as healthcare continues to change, we're just seeing a lot of new structuring happening, either between a for-profit and exempt or with exempts. So there's a lot of joint ventures, different types of entity structures popping up. Sometimes lately there's been some divestitures of profitable business lines out of an exempt into a corporate formation. Finally, the tax reform that I mentioned earlier in the presentation, from an exempt standpoint, a couple of the items that have been on the former Chairman Camp, his radar. He issued a big white paper this last spring. A couple of the items from an exempt standpoint was a 25% excise tax on highly compensated individuals. So that would be compensation over $1 million for the top 5 individuals. So that's a big deal. The other big deal would be not being able to net UBI activities from a taxability standpoint. You would have to report each UBI activity separate. Obviously, both of those are revenue raisers, but they're in that white paper. I think that's it. Let's see, our last polling question. What tax issues are you most concerned with? Healthcare reform, tangible property regulations, tax-exempt issues, extenders package, tax reform, or no concerns at all? And we will close it out. Interesting, healthcare reform. That's consistent with what we continue to hear with our clients. So we will, I think we just touched on that. So key takeaways, we've got about a minute left, and if there were any questions, we've got a few that we will address with you offline. Bob, do you want to touch on just a couple in about 30 seconds?
Sure. The key takeaways for individuals is considering not just this year, but multiple years, coordinating it with your estate and wealth planning, and consider the net investment income tax in your planning.
Yeah, and from my perspective, I think the biggest impacts are the tangible property regulations. I really encourage everyone to get their arms around that. The Affordable Care Act continues to be a moving target, and as we saw in the polling results, that's a big deal for most of you on the phone. And finally, the extenders package. That is a big deal, especially right now as we plan year end and plan for tax filing season. So with that, we want to thank you for attending our webcast this morning. Wish everyone happy holidays, and encourage you to either contact your Moss Adams advisor or your own personal tax advisor, and also visit our website for more guidance. So with that, we want to thank everyone for attending.